Somebody emails me and says, what about the balance sheet? How effective is the balance sheet in helping to slow down the economy, get our arms around inflation? And are they doing it the right way? Should they be coming off the balance sheet even faster than they are?
I wonder if they should come off faster than they are. I think the clearest statement about the balance sheet is that they should have stopped buying 6 or 9 months earlier than they did. I think it's clear that we had something that history will look back on as a bit of a housing bubble. And I think they contributed to that by buying mortgage-backed securities. Now, I certainly think they're going.
矩阵的一个阵列性矩阵里面呢，对它的这个形状呢变得更加规则一点。我如果要把，我到底应该选哪一个，对吧？绝大部分时候，温度啊，对吧？这是维持在20摄氏度，这个是吧？你都已经突破这个表，但是它其实是一个突变的一个跳变的，这样的。这个能理解吧？就是说 a 等于0的时候，不就等于1嘛？那就是线性的嘛。a 等于1的时候，这一项没有了，就等于它，就是说完全是非线，逐步增加。如果库塔手动了，手的方法有0点。如果说0的时候，不就等于1嘛？那就是线性的嘛。研究扩展里面的辅助扫描，比如说这个，我可以让它从0变到这个1嘛。每隔0.1，这样的话就逐步增强这个非线性了，把非线性增强。
Going in the right direction with QT rather than QE. Could they do it faster? Perhaps they could. Would it make a major difference? I'm not sure that it would. Would it add to financial risk? It might, in terms of some kind of accident in markets. In general, David, I think that yields are driven more by the fundamentals of what's happening in the economy and less by central bank policies like QT and QE that I think many in the markets think. You know, I could be right about that, or I could be wrong. But I think people often ascribe to the direct impact of these policies what is in fact a signaling with respect to future monetary policies. And I don't think that now this is an area of stability. The Fed has set an expectation. That expectation is underway. I wouldn't be recommending a major change in balance sheet policies at this point.
Larry, we spoke last week. The Inflation Reduction Act was getting toward being statute. Now we actually have pen put to paper. One of the issues that has been of concern to you is carried interest. You were concerned actually they should go further in cutting back on carried interest. In the end, they went even less far. What do you make of what happened there, particularly with some of the lobbying we saw on Capitol Hill?
I think it's very sad how much special interest lobbyists were able to stop things that are clearly in the public interest. The idea that carried interest, which after all is income paid to people who work at providing a service. Some people provide the service of legal work. Some people provide the service of serving meals. Some people provide the service of asset management. And the idea that the people who provide the service of asset management, who are often some of the best paid people in our country, should be able to have their compensation be taxed at half the rate of everybody else, I think is outrageous. And I think it's very sad that people on the progressive side allowed themselves to be persuaded by very substantial donors to their campaigns that the legislation as it was originally drafted should be gutted in that area. I also think it's very unfortunate, even more unfortunate because it's in some ways a larger issue, that the hugely historically important legislation or in agreement that Secretary Yellen reached with President Biden very much involved to foster international tax cooperation, that's probably going to collapse now, or may well collapse, because Congress wouldn't pass the enabling legislation by going after tax havens. And I sure wish that that had happened. I hope that some way will be found to go back to that set of issues. And frankly, David, it all has me thinking about the role of money and business interests in our system. As you know, I am hardly one who takes the perspective of the most progressive wing of the Democratic Party, most left wing of the Democratic Party that wants to see things socialized or wants to see punitive taxes levied. I tend to be on the more moderate side, but I am pretty offended by what's happened here. And I think business leaders who lobbied these provisions, who want to be explaining about public-private cooperation in the national and global interest and all of that, I think they should always be asked, shouldn't they start by not lobbying to subvert the tax system we have?
Okay, Larry Summers, I'm delighted to say you'll be staying with us because we're going to be joined by Melissa Carney. She's professor of economics at Maryland, and she has convened Larry and some other esteemed economists in Aspen to address the very important question of, after we come through whatever downturn we're going through, where will the growth come from? That's coming up next on Wall Street Week on Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
This is Wall Street Week. I'm David Weston. Our special contributor, Larry Summers, has stayed with us, and we are joined now by Melissa Carney. She's professor of economics at the University of Maryland, also director of the Aspen Economic Strategy Group, which she has convened in Aspen this week with Larry and other esteemed economists to address a critical question, really, of whether the United States could be facing stagflation. So, Melissa, welcome to Wall Street Week. Great to have you here. Let's start with the question of where growth will come on the other side of whatever it is we're going through, because that's ultimately going to be the question here. I understand from economists like you, it comes from one of two sources, either more workers or more productivity. Are we going to get more workers?
We're looking at both fewer workers and lower productivity, as you know. So let me focus on the fewer workers aspect for a moment. The real issue, demographic issue facing the U.S. is we have a plummeting birth rate. And so total fertility in the U.S. is now below the level required to keep population growth constant. And so the issue here is that on average now, a woman in the U.S. is expected to have 1.65 children over her lifetime. So women used to have 3 kids, then it fell to 2. Women were having comfortably above 2 kids for many decades. With a fertility rate below 2, that means our population is going to age and it's not going to grow. And so eventually we're going to have a shrinking working age population.
Unless, Melissa, we have immigration.
That's right.
And that's why immigration, I think many of us at this conference feel is so very, very important. What's your sense of what economists would say, the politics apart, about the immigration policy?
Economists love immigration. We think immigration is a potential answer to our demographic challenges as well as our productivity innovation challenges. Since immigrants come in, they work, they're more likely than native-born Americans to be entrepreneurs and innovators. Of course, as you know, Larry, immigration rates are way down. So we used to bring in, 2016, we had as many as 1 million new people coming into the country every year. That number is now below 250,000. And so the combination of a declining native-born population and a decline in immigration portends even worse demographic challenges than if we were just facing one versus the other.
Let me see if I can do a little arithmetic based on what you said. From 1 million to 250,000.
Yeah.
So that's about 750,000 people a year. So that's about 0.5% of our workforce, maybe a little less. So 0.5% slower labor force growth over time can accumulate to something that is very large.
And if we go back to the birth rates, we have about 500,000 fewer babies being born a year than in the not distant past.
Melissa, if you, what would you say about this? Most people are scared that immigrants come and they take jobs for Americans. And that if there are more immigrants, then there aren't going to be as many jobs for Americans, or if there are jobs, because there's more competition, they're going to be paid less. And that's true whether the job, people think, is working at McDonald's or is working doing computer programming at Microsoft. How should people feel? Shouldn't they have this worry that they're going to be poorer if we take all the immigrants, just like they get hurt if we take a lot of trade from other countries where they have much lower wages?
So the reason economists are so bullish on immigration is because we have so much evidence that immigrants are good for the economy. They are good for most workers. But it is true that there are some groups in some places that will feel wage pressures. And I think the way we solve this issue is to make sure that we recognize the disparate impacts of certain groups. We recognize that low-wage workers in certain sectors might not experience the benefits, the overall benefits that immigrants bring to the economy, and we take steps to help them. I mean, it's not dissimilar to what we have to do with trade too. More imports is good for most people, but some people are harmed by it. We're going to see this too with the shift to a greener economy. Some people are going to lose their jobs, even though it's better for everyone. And so, I think acknowledging that some people feel and are harmed by this, but that's a small concentrated group, and taking steps to address that allows us to do things that make the economy grow and be more productive.
So I want to come back to fertility. Larry's pointed out a way in which economics, whether misperceived or not, may affect our willingness to have immigration. What about fertility? Are there economic causes for the reduction in fertility?
So the decline in U.S. fertility, and it's really being driven by a plummeting of birth rates since 2007. Births fell after the Great Recession. They haven't recovered. You can't point to any policy or economic factor that's changed since 2007. So sometimes people will say things like childcare has become more expensive, and if we just made childcare less expensive, people would return to having more than 2 kids. That is just not the case, right? There's nothing that easy that we could point to. And in fact, U.S. women now are just having births in the same way that women in other high-income countries have reduced their birth rates long before in the 80s and 90s. So I don't think this is going to be easy to turn around. Lots of other countries have taken direct steps to try and incentivize people to have more kids. There's a lot of countries that have experimented with baby bonuses, a few $1,000s. Birth rates go up a little bit in the following year, but nothing like the 20% increase in fertility we would need to get back to replacement level.
Melissa, having an expert like you here, I can't resist stepping out of our mutual lane as economists to ask a question I suspect is on many people's minds. Do you think that the recent Supreme Court decision and the steps that are going to be taken in a number of states, do you think that's going to materially affect the number of births in the United States?
We do have estimates on this based on lots of data we have about how abortion restrictions lead to more birth rates. I expect there will be about 100,000 more births a year. Yes, this is not going to bring fertility rates back to where they were. This is going to mean that some women who wouldn't want to have a child now are going to. Since you raised the issue, I will say that this makes the imperative of doing more to support kids and low-income women in this country that much stronger. Which is, that was something that Congress was talking about for a brief moment in the initial Build Back Better. That stuff got jettisoned. In the post-Dobbs decision paradigm, we are going to have some more births disproportionately born to low-income women, and we need to talk about how we're going to make sure that those children are well taken care of.
So, Larry, can we make up the loss of population and workers with productivity? We have the CHIPS and Science Act now. We have the Inflation Reduction Act, both of which I understand are meant to increase productivity. Can we make it up in increased productivity?
Melissa organized a terrific session here on R&D and science leadership issues. I think there's a lot we can do, but it's both about spending money and it's about spending it well. There was the famous discovery of DNA by Crick and Watson. Today, people can't usually get their first grant until they're over 40. And so I think we need to change the systems as well as putting more resources in if we want to maximize science, innovation, and their capacity for productivity. I think we've also going to have to think about a lot of things post-COVID.
David, there's one other factor here. So we've talked about fewer working age people, less productivity per worker. We also have fewer working age people working. So the decline in labor force participation among people between the ages of 25 to 54 is yet another challenge that we're going to have to deal with in this country that's negatively going to impact growth going forward.
It used to be that 95% of working age men were working. Today, it's 85% are working. That is an extra 10% of people who aren't having the satisfaction of work, aren't contributing to the economy, are much less well-placed to raise healthy, successful families, are often angered and alienated from our society. And so we tend to think of, on shows like this, the path of fortunate college-educated workers. We have got to be thinking about that large group of men much more than women, who are really struggling in our country right now, and what can be done from childhood on to maximize their opportunities.
Yeah, it's such an important point, and as you know, both of you know well, there's been some serious economic work suggesting that opioids actually have been a not insignificant contributor to that problem. Thank you so much. It's been a great discussion. I wish I were out there and asked with you. I could learn a lot more. But thank you so much to our very special contributor, Larry Summers of Harvard, and Melissa Carney, professor of economics at the University of Maryland. Coming up, it's one thing to handpick your successor. It's quite another to make it work. That's next on Wall Street Week on Bloomberg.
Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
So for somebody who's watching this and wants to be a successful global business leader, what are the skill sets?
I would prepare well before I got the job or was given the nod.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Finally, one more thought. Heavy is the head that wears the crown, at least according to Shakespeare's Henry IV. And it's not only heavy, it's hard to pass that crown on to the next head, at least judging by how often it doesn't seem to work. We don't have to go all the way back to Lear to find leaders bungling their succession plans.
We have divided in three our kingdom. It is our past intent to shake all cares in business from our age, conferring them on younger strings.
We all know how that worked out for King Lear. There are plenty of more recent examples, though, particularly in the world of business, like Jack Welch anointing Jeff Immelt to carry on his legend at GE, something that didn't work out so well, although Jeff seemed to be the last to know when he spoke to our John Micklethwaite in 2017, not long before he had his crown removed.
We always have a group of successors, and I always think you got to earn it every day. So yeah, I've been doing it a while. I feel great, and we'll see where it goes.
Or Kevin Johnson, who had the bad fortune to be the second CEO to replace Starbucks chief Howard Schultz, only to be succeeded by, you guessed it, Howard Schultz. Though when I spoke with Kevin in 2019, he admitted that it was tricky.
In a transition from founder-led to founder-inspired, those transitions oftentimes are the most difficult and the most critical transition that any company will go through.
And this week, we got yet another example, when the founders of the Carlyle Group announced that their hand-picked heir, Kyu-San Lee, would be leaving abruptly to be replaced, at least temporarily, by Bill Conway, one of those founders who picked him.
This has definitely shaken the investment universe. Let's not be coy about it. 10 p.m. Eastern on a Sunday night. And remember, like I said, he's stepping down before the contract is even up.
But it wasn't only Q Lee who stepped down this week. We also saw a legend prepare to move on when Serena Williams, arguably the greatest of all time in women's tennis, announced that she would be retiring after the U.S. Open this year, something she had just joked about earlier.
Every tennis player thinks about the R word as soon as they hit 5 years.
And when it comes to Serena, I'm not sure that we're going to see any successor anytime soon. So given how much drama there is around the subject, it shouldn't be surprising that there is a hit TV drama series given over to the matter of succession. Because it's one thing to know the boss has to go. It's quite another to figure out who should be the new boss, especially if you're warring with family members.
He's erratic. He's making bad decisions. If he's not careful, he's going to destroy the company.
Emily, you going to do something?
I think I'm the best option.
Oh, right, because you like playing boss?
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.
This month, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th, only on Bloomberg Television and Radio.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Problem is you can never time the market well. And so the message is stay in it, stay diversified in it. As a manager, your job is long-term investment performance. There's no business that helps people more than this business. We help people achieve the most important goals in their lives.
A penny saved is a penny earned. That quote is attributed to Ben Franklin. And that philosophy struck home with Rupert Johnson, who in 1947 named the retail brokerage he founded after Franklin.
My grandfather just was a big fan. I think he's probably the most interesting of the founding fathers.
Almost 3/4 of a century later, his granddaughter succeeded her brother as CEO of the company, now called Franklin Templeton.
No, there was never any pressure to go into the business. I always aspired to be in the business.
In 1957, the firm's funds had $2.5 million in assets under management. Now, under Jenny Johnson, that's climbed to $1.4 trillion.
Today, we're a dominant global asset manager, probably more coverage than anyone else.
Just after Johnson took over in 2020, Franklin Templeton closed its biggest deal ever, the $4.5 billion takeover of Legg Mason. Now, the firm operates in over 30 countries with 1,300 investment professionals. It offers more than 200 investment strategies.
My father always said, take care of the client, and the business takes care of itself, right? And so the reputation of the firm and the reputation of the family are very much intertwined.
Franklin Templeton is a much different company than it was 3 generations ago. But then, Ben Franklin did say, when you're finished changing, you're finished. Let's talk about this company. People may not be that familiar with it. This company was started in 1947 by your grandfather, is that right?
That's correct.
And was he in the money management business before?
So he had a brokerage business, Johnson & Associates, and he set up a little subsidiary called Franklin Funds. And my father, his older brother, took over the brokerage business, and my father wanted to do his own thing as an entrepreneur. And so he asked if he could run Franklin Funds. It was $2.5 million in assets and a part-time employee was the extent of it. And as he reminds me, it was $10,000 in revenue at the time.
So when you were growing up, did your family say you're going to be the CEO someday of a money management company that we own?
No, there was never any pressure to go into the business. I always aspired to be in the business. There was only one time where I considered a different career, and I wasn't focused on being the CEO. I loved what I did. I ran technology, I ran the operations. I kind of came up on that side of the business. And I think my brother, after 15 years, was ready to do something different. He had an opportunity to be the control person of a Major League Baseball team. I mean, who wouldn't want to do that? And so it was kind of time.
What team is that?
The San Francisco Giants.
Okay, so have they won a World Series under his leadership yet?
They haven't. I was on the board when they won their 3 World Series,
okay.
so I just will put that out there.
Okay, so let's talk about the size of your company and what it actually does. Today, how much assets under management do you have?
We about, I think, 1.45 trillion.
Okay. And most of what you have done over the years is offer mutual funds, is that right?
Correct.
Now, in the last 10, 20, 30 years or so, a new phenomenon called index funds or ETF funds have come along, and they say more or less, don't worry about smart money managers picking good stocks. We're just going to get you the index, and you don't need to worry about paying higher fees that mutual funds charge. How does that affect your business?
So, and let me bifurcate that answer. So one is ETFs, I look at as a vehicle. Oftentimes, people confuse them and say, well, they're just a passive index, but they're just a vehicle to deliver your investment capabilities. So at Franklin Templeton, our expertise is people managing money. You have a certain mandate and a risk return, and we manage it that way, and we deliver it. We're agnostic to the vehicle in which we deliver it in. So it might be a mutual fund, it might be an ETF. We have 99 ETFs. It might be a separately managed account or a collective investment trust. So that's the vehicle. We're agnostic to that. Now, the passive versus active question, which is sort of your index question, we've just come off a decade where essentially interest rates were zero. You could borrow money for nothing. You didn't get paid to be in fixed income. And so where were you going to put your money? And meanwhile, the government was essentially printing money. And that pushed everybody into the equity markets or into private assets. In that environment, passive funds often outperform in a momentum market. Having said that, as an asset manager, your job is to provide risk-adjusted returns. So, it got to the point where the top 5 companies in the Russell 1000 large cap represent 40% of the index. And had excess returns at the time. But the average investor cares about downside protection too. So a manager, I think at one point, one stock was 12.5% of the Russell. So Russell 1000. So that's a lot of exposure from a risk standpoint. It's a heavy concentration. So as an active manager, you're going to look at it and say, I don't necessarily want to have that. I want a more diversified portfolio. But that meant you probably underperformed. But now, when you've seen the market decline, those top 5 declined 24% on average, whereas the rest declined about 17%. So again, as a manager, your job is long-term investment performance.
Let's suppose I say, all right, I want to put some money in a Franklin Templeton fund. What type of return should I expect on a stock fund? Should I be getting 6% a year, 5%, 8%? What should I realistically expect after fees?
Well, if you look at, I think it's the S&P from its S&P 500 from its sort of beginning, I think the average return is about 10.5%. The last decade of this kind of very momentum market, it was closer to 15%. The problem is people then start to expect 15%. I think you take too much risk for somebody trying to put money away for retirement to expect something like 15%. So I think a pre-tax 10% return over a long period of time. You're going to have time when the markets go down, but at 10%, the average is probably a reasonable return.
And after fees, something like?
Probably like 9%.
Okay, so that's what people should realistically expect. But in the business that I've been in, the alternatives business, private equity and things like that, they've been getting higher rates of return. You have kind of said, if you can't beat them, join them. Recently, you have bought a lot of alternative businesses. Why did you do that?
Yeah, so I tell people, my grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, they're half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. This is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor. I would say that that Bitcoin is the greatest distraction from the greatest disruption that is happening in financial services today.
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
For the asset and wealth management industry, M&A activity was on fire last year. According to PwC, there were at least 296 deals in 2021. That was 50% more than in 2020, and the most since 2000. One of the big deals announced last year was Franklin Templeton's purchase of private equity fund manager Lexington Partners for almost $1.8 billion. This year, the pace has been even faster. Through the middle of May, there were 109 announced deals, 11% more than at the same time in 2021. A couple of the big ones: UBS bought robo-advisor Wealthfront for $1.4 billion. AllianceBernstein paid the same amount for private credit manager CarVal, and Franklin Templeton bought asset manager Alcentra for $350 million up front, and it could pay another $350 million if Alcentra hits certain targets. PwC notes, though, that deal momentum slowed in the second quarter. What to expect for the rest of the year? Jenny Johnson has indicated Franklin Templeton will continue to explore ways to accelerate growth in infrastructure and wealth management via acquisitions. So as we talk today, the United States economy seems to be slowing down a little bit, and some people actually worry about a recession. How has that affected the money management business that you're in? What are your investment professionals telling their clients?
So we have 18 independent investment teams. And I can tell you that our macroeconomists have differing views on whether there'll be a recession, if there's a recession, the depth of a recession. So I'm going to say that it depends a bit on that. But what I look at is we're looking at some statistics on market returns. And in a 20-year period between 2001 and 2020, or I guess 2002 and 2021, there are 5,035 trading days. If you missed the 10 best days of the market, you lost 65% of your return in that window. So the problem is you can never time the market well. And so the message is, stay in it, stay diversified in it, and because too often you see people when the market's gone down, they pull their money out, they wait till the big increase, and then they put their money back in. And so you just have to be a long-term investor and stay diversified.
So today, the Federal Reserve has been criticized by some for not raising interest rates quickly enough, and some people say it's raised it too quickly. Where do you come out on what the Fed has done? You think the Fed has done a reasonably good job in dealing with higher inflation?
I think the most important thing for the Fed to do, and they probably could be a little bit better at it, is communicating what their plan is. Markets can absorb as long as they understand and there are no surprises. And so I think the most important thing for the Fed is to communicate their plans as they're raising rates.
Okay. And right now, today, if I had some money, should I be putting it in a mutual fund, or equity fund, a fixed income fund? What's better today, given where the markets are? You think stocks are likely to keep going up, or you think fixed income, because interest rates are going up, are likely to be a better buy for people like me?
So, I think we know that the Fed is going to continue to raise rates. So that's going to make any kind of longer-term fixed income a little bit of a challenge for the short run. The equity markets may go down some, or they may be bottomed. I don't know that any of us know that. We're entering into earnings season right now. But again, I would just say to folks, just have a good diversified portfolio that's appropriate for your risk level and stick with it. And if anything, don't look at it. If you can't afford to be invested for probably a couple of years, maybe cash is a better move right now. But if you can afford to be invested for a couple of years, then set up a diversified portfolio and just don't look at it.
Some people say that one of the best opportunities now is cryptocurrencies, though crypto has had some problems. What do you tell people that say they want to be in cryptocurrencies? Do you offer the opportunity for people to invest in crypto through Franklin Templeton?
Yes, actually we do. So first of all, I always say that Bitcoin is the greatest distraction from the greatest disruption that is happening in financial services today. So I wish, because every time everybody gets in a conversation about crypto, it leads into a conversation about whether this currency, whether it's Dogecoin or Bitcoin, is of value. Forget that. That's like a religion. You either get a believer and a non-believer, and they're never going to agree. But blockchain as a technology and what it can do is going to be hugely disruptive. So not only is it going to be disruptive on traditional back offices and just create much greater efficiency, but disruption on business models. And I'll give you a couple examples of that. Today you go on Google and they capture 100% of your value on your search via their ads. There's a company that has been set up, and when you use their search engine, they're actually paying you in cryptocurrency for some portion of your economic value that you're bringing to the table. There's another company that wants to be the fastest streaming service out there. So when you're watching the content, so as I'm watching it on my, say, phone, I'm agreeing to let them cache their content on my phone. So now that you want to watch something, it only has to jump from my device to your device. And they're paying me in their currencies to leverage my device's infrastructure. So now I'm not just a client. I'm capturing the economic value as they grow as a firm. And by the way, I've become part of the infrastructure. They don't have to buy as many computers because they're leveraging their client's infrastructure. So the technology enables that kind of disruption. And then you have new revenue streams, like I think the NBA raised $500 million in selling off NFT video clips. So that's a new stream. I can imagine, we talked about my brother and his role in the San Francisco Giants. You can imagine sports teams. What if you sold 1% of the San Francisco Giants to 100,000 people? And oh, by the way, they get bragging rights that they own it. They own it with their token. Maybe they get special access to the coach who's going to do a post video after the game. Right? It becomes a loyalty program.
What do you do about ESG? Are you very conscious of investing companies that have good ESG performance?
Yeah. Well, again, we're asset managers, so we do what our clients ask us to do. But anybody who's been in Europe for any amount of time, and we've been a big manager in Europe for a very, very long time, knows that there is a big push on ESG. And so it's been a big focus of ours. What you have to think about in ESG is you have to first think about how it's risky. What are these risks, the environmental, social, and governance risks to the underlying companies? How are you measuring its alpha contribution to your portfolio? And finally, what is the impact of that on society? And so all of those things are really important. And you see the regulatory environment is mandating that you have this. In the US, they tend to be more focused on what are you saying you're doing, and then prove to me that you're doing it. And Europe tends to be more focused on what is the actual societal impact. But clients are absolutely demanding that you not only report on returns, and we all have a fiduciary duty to have good returns, but also what is the impact. I feel strongly that people should use a financial advisor, because a financial advisor will deal with the emotional difficulty of a market drop.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So let's talk about your own background. So where did you grow up?
Well, I was born in New Jersey, in California in 1973. My Franklin bought a company out in California, and so I moved out to California with the family.
And so you grew up in a pretty large family?
A lot of kids, 7 children in 10 years, yeah, a lot of chaos.
And did at the family dinner table, they talk about money management all the time?
No, I mean, as a matter of fact, my mother, after having 7 kids, went on and graduated from Stanford Medical School. And I would say there were way more conversations around the sciences than there were around financial services and asset management.
So when you were growing up, did you say you wanted to do the same, or what did you say you wanted to do when you were growing up?
I, for some reason, always wanted to be in this business. There was a period of time in college where I thought maybe I would become a coach, because I love sports. I was a double major in economics and physical education, and I thought that would be a fun thing to do. And then I decided that I could probably volunteer as a coach.
Where'd you go to college?
I went to University of California, Davis.
Okay, and so after college, what did you do?
I went to, my father said, if you're going to be in the financial services business, you should probably live in New York. And so I got a job at Drexel Burnham, and I worked in kind of like a trainee program at Drexel Burnham.
And at that time, did you think a woman could ever be the CEO of your family's business?
You know, I grew up in a household where it was viewed that women could do as much as men. As a matter of fact, my father was the first one to hire, we had the first female general counsel in the asset management business. He was obviously very supportive of my mother going back to school and graduating as a doctor. At one point, we had 3 times the number of female women running our investments than the industry did. That's through acquisitions. That has actually declined. We're about at where the industry is.
Did your brother, who you succeeded, and your father, who he succeeded, did they say don't screw up the family business when you got the job? Or?
Trust me, you do not want to screw up the family business, for sure. That is, and actually it's why I think that having the family still involved in the business is important. I mean, my father always said, take care of the client and the business takes care of itself, right? And so the reputation of the firm and the reputation of the family are very much intertwined. And so when you feel that responsibility, you make sure you're doing what's right for your clients.
So today, you're happy with what you're doing and being the CEO?
Love it.
And do you think that today this is a job that young women and young men should really aspire to go into the money management business as opposed to public service or things like that?
So it's funny, I tell the story about saying to my kids, so are any of you going to follow me in this business? And my daughter, who makes documentary films, says, no, Mom, I want to do something that helps people. I said, are you kidding me? Like, there's no business that helps people more than this business. We help people achieve the most important goals in their lives. And we have to, every day we walk in, and I think that the employees at Franklin Templeton feel this, we walk in with a fiduciary duty and a responsibility to, help a person who wants to retire and be independent financially, or if you have a special needs child and you worry about saving enough money to make sure that child's taken care of after, or you want to save enough money to launch a business, whatever it is. These are people's dreams, and there's no better business to do this than ours.
So what do you think is the biggest mistake that investors make when they generally look at what they're doing? Your observation would be that the typical, most common mistake investors make is what?
Is they sell low and buy high. The typical investor. That's why I feel strongly that people should use a financial advisor, because a financial advisor will deal with the emotional difficulty of a market drop. When you suddenly look at your retirement account, it's down 25%, and say, don't worry, we're in this for the long run, just stay in. And so it's, that's been one of the biggest challenges, I think.
And what's been the best investment advice anybody ever gave you?
Be diversified and stay in the market. I think the biggest issue is people hesitating and not getting in the market.
So I assume, you go to cocktail parties from time to time, you're running Franklin Templeton. I assume people come up to you and say, Jenny, can you give me some investment tips? What should I do with my money? Does that happen a lot?
Yeah, well, if it happens, what I would say is the best thing to do is actually to ask an expert, financial advisor who knows exactly what your needs are. Because, the beauty is people can customize for their personal needs. I don't know what a person's situation is. And frankly, I just manage 1,300 investment people. That's not my expertise.
Well, of this job, what's the pleasure of it? What's the greatest pleasure of running Franklin Templeton?
I think it's this knowing that we're helping people achieve the most important goals in their lives.
What's the greatest challenge of running a company like this?
I think, look, it's hard. My dad has a saying. He says, you either are a tough boss or you work for one. Sometimes you have tough decisions. You have to, terminate people or move them into a different role. And, sometimes a job's grown beyond somebody's capabilities. Sometimes you have to make a decision where you're outsourcing, and those are tough. People decisions are the tough part of the job.
Let me ask you, isn't it really difficult that when your father is around and your brother is around, both of them are CEOs, you've got two family members who are CEOs, and they must know your business pretty well. Isn't that the toughest part of your business, your job?
Oh, I think that's the greatest benefit. When we're making it, we've done, I think, 8 acquisitions in the last 2 years, and very much engaging in conversations with them about, is this the right time, here the thinking on it, and knowing that their goal is exactly the same as mine. So any feedback they have, is coming from the right place. So I think it's a tremendous benefit.
You're one of the most fascinating entrepreneurs because you all started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad.
From
isn't
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business and fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very definitely from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's
and
fun.
it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, and sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. And I watched the offshoring, I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
Matt Miller with Kaylee Lyons in New York and Anna Edwards in London.
Australia's central bank raises interest rates twice as much as forecast.
Then Surveillance for in-depth analysis.
Alongside Tom Keane and Lisa Bramwitz, I'm Jonathan Ferro, the RBA front and centre.
How does Japan get away with not raising rates?
Can it sustain? It's normal at a time when everybody else is facing a very different reality.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
There's an old saying in finance that cash is king. But when it comes to payments, the data suggests that's no longer exactly the case. According to the latest World Pay report, cash now figures in less than 20% of in-person transactions around the world.
The payments industry from the beginning has really focused on getting people to use electronic forms of payment. In fact, if you look at like the US, for example, you basically have been moving around 2 to 3% of payments from cash and check to some form of direct electronic just about every single year.
Total card volumes ex-China today at $20 trillion, and there's another $14 trillion worth of cash and check left to digitize. Even at 80% level, card penetration is growing. So yes, we are moving towards a cashless society.
A new technology is promised to kick these trends into a higher gear.
The terminal on the till of the merchant. Now, depending on how old one is used to that, at least in the developed world. But that is not everywhere. But everyone has a phone. So electronic payments can end up in a super simple way in everybody's hands. And for our business, that's a massive growth opportunity.
Mastercard is already seizing that opportunity. After dipping in 2020, revenues shot past pre-pandemic levels in 2021, driven by a rebound in consumer spending. CFO Sachin Mehra knows this boom is likely to fade, and he's set on finding ways to keep the momentum going.
The key to being successful in this kind of a environment is to have a diversified portfolio. You've got to be nimble from an expense standpoint. You've got to be very disciplined. As a finance officer, what I've got to do is I've got to make sure that we are investing in those resources which are currently in demand from a customer standpoint, but at the same time not losing sight of the long term.
CEO Michael Miebach counts on Mehra to do more than just oversee the balance sheet.
The top line for me is advisor and confident.
You're conciliary.
Yes, he's quite happy pushing back, and the same vice versa.
The role of the chief financial officer has actually changed fairly dramatically over this 20-plus year tenure that I've had. You know, in the past, it was more of a function of, let's make sure the numbers are good, let's make sure we get a great control environment, let's make sure we're actually able to close the books on time, let's make sure we've got all the financial elements of the business in order. The job of the CFO, in our view, in my view, is a function of making sure we're creating the right linkage between what the purpose of the business is, what the strategy of the business is, and delivering on the financial returns for the company, all while driving long-term shareholder value. We're in the business of leading beyond the numbers. It's great that we know what the numbers are. How do we use those numbers to better drive execution of the business to accomplishment of the strategy of the company?
Mastercard's core business is, no surprise, cards. Carded products currently account for over half the company's revenue. The company set ambitious growth targets at its 2021 Investor Day, committing to expand this core and to diversify beyond it.
We've been on a 6-year strategy to be a multi-rail company. In plain English, that means whichever way you pay, we will enable that. Despite the fact that card is in our name, it's essentially any type of payment. We have the reach, so I think we're reasonably well positioned.
I mean, you've just got to recognize not only where the consumer is today, but where they're going to go, because a lot of what we've got to do takes time to implement. And is it difficult? You'll get it right sometimes, you'll get it wrong sometimes, but hopefully you're getting it right more often than you're getting it wrong, and you're working with through that.
Forecasting preferences is complicated by an uncertain economy. Consumer confidence has been plunging to historic lows, and recession calls are getting louder. Still, a slowdown isn't likely to cause a crisis for Mastercard and its peers.
Contrary to what people often perceive, I think payments as an industry, it will be quite resilient in a downturn.
Generally speaking, even during a recession, the amount that consumers spend actually does not go down. It continues to grow. I think the thing that people are worried about more in the payments industry is kind of how does the mix of spending change?
First thing that typically happens if you're going into a recessionary environment is people tend to pull back on discretionary categories of spend. They move into the non-discretionary categories of spend. They pivot into food, they pivot into rent, those kind of payments, which are most important for them to meet. But the rails still stay the same. So the rails which run debit and credit are exactly the same. The technology is the same, the distribution model is the same. So those areas don't necessarily change by virtue of moving into more of a debit or credit environment.
One area that Mastercard has been moving vigorously into is B2b Payments, a market expected to reach $25 trillion by the end of the decade.
We think there's tremendous promise in the B2B area. The card business, as in the elements of the B2B space which are served by cards, are doing well. They're doing very well. And it's in the small business space, in the mid-market, it's in the large corporate space. All of them do really well. On the accounts payable side, I would say we're in the build phase. And here we're about building an open loop environment to enable payments on accounts payable rails.
Whereas the opportunity in that space is different to consumer payments, where there is a global standard. The global standard is Mastercard. The global standard are card payments because that's been established. That isn't quite established yet in B2B. And I think the more benefits we bring into the payments that are easier than just making a really complicated cross-border payment, I think we'll find our way there. And we're going to see an explosion of creativity. A lot of other companies coming in and using those rails, innovating on top of them.
Pursuing new opportunities takes capital. Mastercard has spent billions acquiring companies that add capacity and diversify its infrastructure. Acquisitions and partnerships have helped Mastercard offer more value-added services to their clients, tapping into a lucrative revenue stream.
What we call services, which includes data, insights, consulting, managed services, loyalty, and our fraud capabilities, is roughly 35% of the revenues of this company.
Wow.
Yeah. So it's not insignificant. So oftentimes people think Mastercard and think card. Very important, but there's a very different part of Mastercard's model.
From a balance sheet perspective, Mastercard has maintained a healthy leverage ratio, even as it's put more resources into acquisitions and taken on more debt, giving the company flexibility to continue investing.
We don't go in and say, well, right now valuations are lower than they were a year ago. Let's go and buy something. That is an opportunistic approach that doesn't work for us.
For me, it always starts, what are we trying to accomplish from a strategy standpoint? What are our inherent capabilities we as a company have? What are the gaps in our inherent capabilities to meet that strategy? And then for those gaps, is it best to build, buy, or partner?
And then we're out there and we're trying to find the right companies together and going to make sure that we have a clear view on short and long-term synergies and so forth. And then we both talk to shareholders and to investors to explain what we're doing and why we're doing it and why it's good.
Shareholders have reason to appreciate Mastercard's capital allocation strategy. It's included annual share buybacks and steadily increased dividends.
How do you prioritize the amount of money that you put toward innovation and toward building out different businesses versus share buybacks and dividends? Because Mastercard has traditionally had a robust program in rewarding shareholders.
Right. First call of capital is towards growth of the business. After we have done that, it's about making sure we're being good stewards of capital and returning excess cash to shareholders with a bias towards share buybacks.
And then once you start to come to say, I have dealt with my strategic priorities, I either have invested in my organic growth or in acquisitions, then excess cash we will return back. Generally with a preference for buybacks over dividend because it gives us more flexibility, but that's been a good model for us. It's been working well and it's been well received by the market.
Coming up, how the tap has taken Mastercard places that the swipe alone could not.
What it's really made a difference on has been in terms of how it's driving a shift from cash to electronic forms of payment, particularly on the small ticket items.
And later, how Mastercard has staked out a place in the volatile universe of cryptocurrencies.
In the crypto world, we play the role as an on-ramp.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Sachin Mehra joined Mastercard as group executive and corporate treasurer in 2010. Over the next decade, he took on several different roles before being appointed chief financial officer in 2019. That's a very different path than the one he started out on.
I grew up in India. I went to school there. I went undergrad there. I worked with the family business there. It's a textile business, which my grandfather started, my dad and my uncle took over, and then my brother and I got into. And I worked with him for 3.5 years. Then I came here for business school. The moment of truth came on graduation day. My dad got on the phone. He congratulated me. He said, well done. You graduated. I'm looking forward to having you back home. My brother, who's older than I am, who went to business school as well and went back home and worked with my dad, got on the phone, congratulated me, and said, so Sachin, what are you going to do with your life? And I'm going, well, why are we having this discussion? Dad wants me to come home and work in the family business. He's like, yep, that's what Dad wants you to do. What do you want to do? And then it really got me thinking. And I said, hey, given a chance, I'd love to work in finance in the US.
Mehra took the chance, even though it took him 6 months to land his first job at General Motors, where he worked for over a decade. Then it was on to the energy industry at Hess Corporation before finding his way to Mastercard.
Today, my dad couldn't be prouder of the fact that, I chose the path I did. Obviously, he misses the fact that we're not there as a family, but that's just part of life, right? We've all got to grow and blossom and groom.
Did he accept it at the beginning?
It took him all of 30 minutes to get there.
When Mehra gets together with his team in the employee cafe on Mastercard's campus, it's clear that he's in his element.
Well, more important, more fun stuff. What's the plan for the weekend?
And of course, the cafe provides a demonstration of the tap and go technology that's changed the game for payment companies.
Can I just get a regular coffee with milk, please?
You want regular coffee?
With milk, please, yeah.
Okay, that will be $5.71.
You got it. All right, we're going to make this work. There we go.
I think contactless is a very powerful catalyst for accelerating cash-to-card conversion. In the last 2 years, what we have seen in the US is card penetration growth rate annually has doubled versus what was the average in the prior 5 years. The pandemic was one of the reasons people didn't want to touch cash. There's a lot of e-commerce purchases, but contactless definitely contributed to this growth as well.
It's made a change. It's really made a difference. What it's really made a difference on has been in terms of how it's driving a shift from cash to electronic forms of payment, particularly on the small ticket items, which is really, really important. Because at the end of the day, our model is as much about converting the dollar value of the spend as it is about the number of transactions we can get over our network. And even though it happens to be a $2 transaction, a transaction is a transaction on which we make revenue, on which we can deliver services, and that's really important.
Mastercard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting the cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So biometrics, I think that's where it's going to go. And I think we've reached that point that people are sick of too many passwords. People are sick of typing in stuff. And there's also too many wallets and other IDs and stuff that is around. So why don't you just, everybody has a smile. So just play with your smile, there you go.
How much are you investing in that? How quickly do you see that becoming the next tap and go?
Yeah, so look, I think this is going to take a while. These things have an adoption curve, which typically is fairly flat in the early part, and then you start to see some level of steepness.
Mastercard's next breakthrough may be born in one of its global tech hubs. The company has opened innovation centers in Australia, India, Europe, Canada, and the United States.
These are spaces where we draw in customers, where we draw the local community. We have them in big cities where the latest technologies and the players are all around us. In New York City, it's in Tech Alley, and everybody in the tech industry is around us. It's a point where people want to work and we attract the best talent. And we go, and this brings us back to the CFO, we go and look at our vitality index. So how are our revenues looking? What is generated from new products? What do we see? Is there real momentum? Is there real growth? And if you overlay that and link that back to our tech hubs in these regions where we have them, clearly that is what is driving our new solutions.
From an investment standpoint, we try and make sure we've got our foot in the door in all of these new and emerging technologies, because what we don't want to do is play favorites with one versus the other. We want to make sure we're investing just appropriate amounts of money to have skin in the game, to know that if this thing has got legs to it, we want to be at the inflection point for them to ride out.
In your tech hubs, can you act like Bond, James Bond, in one of the Q movies, in like the laboratories, we walk in and they, you sort of face off and clear the system, and they sort of do this?
There are some people who are privileged in this company who can do that. Not everybody can. And I'm not one of them. I can tell you that.
That's not you.
No, that's not me.
Coming up, how Mastercard has embraced the brave new world of cryptocurrency with all its ups and downs.
So long as we follow our principles, we think we're in really good shape.
And Sachin Mehra tells me what advice he'd offer a CFO just starting out in the job.
I think it's important to stay calm. I think it's important to recognize that change is going to happen. You can't fight change.
This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons. Just keep at it.
You will put a woman on Mars. You will bring forth global cooling. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Like many of its counterparts in the payments and financial services industry, Mastercard has developed products and partnerships that bring cryptocurrencies into its networks.
I think from a payments and payment system perspective, the players and members that make up that ecosystem are really agnostic. To them, crypto is just another currency, literally, just another asset.
At this point, the overall revenue contribution is still so small. It's very early, but if I'm a card company, it's better to invest and also lean in and partner with some of these companies for future revenue growth rate versus kind of sitting on the sidelines.
Crypto is a term that encompasses a number of different projects, including central bank digital currencies and private sector stablecoins. Also, digital assets like Bitcoin, whose volatile valuations and susceptibility to fraud have raised plenty of anxiety among investors. Mastercard's long-term plans to stay in the space haven't wavered.
We're not really in the crypto hype of investing around crypto. We like the fundamental technology and the promise that it brings to solve problems that have not been solved. So if we see more revenue coming out of B2b solutions that leverage blockchain technology, for example, tokenized bank deposits, just to throw out one example, cross-border payments, whatever it might be.
In the crypto world, we play the role as an on-ramp. So people use Mastercard card products to buy crypto, our debit and credit products. So that's the on-ramp. If people want to spend money as in fiat currency to buy crypto, and we act as the off-ramp. And the off-ramp is when people want to encash it, we help them actually gain access to be able to use their crypto balances everywhere Mastercard's accepted.
We engage with central banks on central bank digital currencies. We engage with governments on how a policy could look like, how regulation could look like. We engage with the startup community and say, come on in, let's sit around the table in one of our tech hubs and we discuss what solution actually is needed by whom and how we can bring it together. They have the greatest idea, but the greatest idea needs a path to scale. That's what we can bring.
Is there a potential liability because of the volatility, because of how Bitcoin and certain other cryptocurrencies have been painted? Is there any liability for Mastercard?
Yeah, well, so long as we follow our principles, we think we're in really good shape. And the principles we care deeply about are stability, as in stability of the currency in question. Point number two, it must meet consumer protection requirements, and it must meet the laws of the land. And this is not new news to us. We've done this in the space for the last 50 years for everything we've been working with regulated financial institutions on. And so, which is why when we got into the space, the first thing we did was define principles. And we will keep abiding by those principles in what we do.
Yeah, I feel happy because we're in the discussion. We're shaping the ecosystem. And then one day it'll look like what we have done in many other spaces over the past years.
Sachin Mehra is a leader within a company that has the power and reach to shape ecosystems, and he'll be making strategic and financial decisions that shape the business. I wanted to know what he sees when he looks ahead.
What's the opportunity for MasterCard in the next 10 years that most excites you?
There still remains a very sizable consumer payments opportunity, which we stand very well poised to actually capitalize on. This is the trend of the shift from cash to electronic forms of payment. If you think about it globally, there's still a ton of cash, which remains to be electronified, and that opportunity is huge. The second pillar for me is around, we have identified over the past few years a sizable total addressable market in what we call new payment flows. Bucket number 3 is around services. It goes back to our insights, analytics, our fraud management capabilities, and everything we're doing in that space. And then the last piece is around new networks, which is around open banking and digital identity.
What are some of the challenges for MasterCard over the next 10 years that keep you up at night?
It's around staying plugged in on what's going on from a technology innovation standpoint and making sure we're leading from the front, not turning our back to it and saying we're going to walk in the other direction. We've got to engage with people who could potentially be disintermediators, competitors, to let them know what value we can bring while they're executing on their strategy. So that's number 1. Number 2 is, look, I mean, the world is getting more and more into a regulatory environment where regulators are playing a bigger role, nationalism is playing a bigger role. It's important for us to continue to do everything we're doing by being deemed local. It's important to be a global company, but be deemed local. And that's going to be important for us to execute on. Because at the end of the day, sitting in my role as a CFO, strategy is great, vision's fantastic, but what really matters is, can you really deliver and execute? And we've got to stay focused on execution, and that's what we do every day.
What's the biggest change that you see your role having over the next 10 years?
That's a really good question. Honestly, I'm not really in the business of predicting that much as it relates to how it's going to change. What I can see happening is greater emphasis on making sure we're leading from the front on executing, but also failing fast. And that's where a CFO can play a big role. And by that I mean, you're not always going to win. There are things you're going to do. Hopefully you get more right than wrong, but recognizing things which are not working out and making sure you actually fail fast on them and get out of them. Because you can fall in love with stuff, keep doing it, keep wasting resources, don't only realize that it's not going to pay off. And I think the emphasis around that is going to only increase for CFOs in a scarce capital resource environment.
What advice would you give a CFO today?
I think it's important to stay calm. I think it's important to recognize that change is going to happen. You can't fight change. What really matters is how you can get up and actually deal with that change. That's super important for a CFO. Being really clear and crisp in your communications. The outside world wants to hear in very simple terms what exactly this company stands for and why they should believe that you are a good investment. And notice I've said nothing about financials and I've said nothing about necessarily financial infrastructure and systems, because I do believe as a CFO, those things are table stakes. You've got to make sure that stuff happens. You've got to leverage technology. You've got to drive efficiency in the business. You've got to get the numbers right. You've got to have a good control environment. But what's going to call you apart is the other elements which I spoke about.
If MasterCard can meet ambitious goals for growth in its core business and build on strategies that are taking payments to the next level, Sachin Mehra will deserve a lot of the credit. I'm Lisa Abramowitz. This is Bloomberg.
So what happens is that we create some icons, we call them tags, and they have a signal within them. And when you stare at that, your eye responds to it in a particular way. The way in which that eye response occurs is a signal that we pick up on the visual cortex of the brain, at the back of the brain. So the sensor is looking for the signals we create here that come through the eyeball, through the brain, and then onto the visual cortex. Once we've got it there as a signal, we can grab that, we understand what that signal looks like, and we can turn that into a command or whatever we're trying to control. There's multiple places where we think this technology can be applied, perhaps in, driving or commanding unmanned ground vehicles or unmanned naval vessels, perhaps providing menu selection and control within a control room environment, maybe in a nuclear power station. All those kind of things are perhaps in the bailiwick of this technology.
Okay, so you're moving in on me, quick. You're distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Good morning, welcome to Daybreak Australia. I'm Heidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
Good evening from Bloomberg's World Headquarters in New York. I'm Sherry Yan. The top stories this hour. China set to report key economic figures, including industrial output and retail sales, with COVID lockdowns and the property slump threatening its recovery.
Saudi Aramco posts the biggest profit of any listed company globally thanks to high crude prices and production.
And a busy week for earnings in Australia, with a quarter of the ASX reporting. Retailers set to provide insight into the health of the consumer. U.S. futures under a little